As many of you are aware, the story of the day was President Trump calling off a future summit meeting with North Korean leader Kim Jong-un. Now, the stock market did fall after that news was released. However, we did end up closing well off the session lows. We were still down by 0.2% in the S&P 500, but we'll see what all that means for our market posture and more. And I also wanted to look at a particular area of the market that actually benefited after that news broke. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's May 24th, 2018. If you're new to these videos, we want to welcome you in. Thanks for checking them out. Remember, you can always subscribe to our YouTube channel by clicking the subscribe button. You can also give us a thumbs up if you appreciate these videos on a daily basis, and also let us know what you're thinking in the comments area. We have a description area where you'd be able to join our email distribution list as well. In addition to YouTube, David and I are also heavy users of Twitter. We'd encourage you to follow us. My handle is @BrandonVanZee. The Market Scholars handle is @market_scholars, and David Settle's handle is @DavidSettle42. We appreciate all of your likes and retweets of these videos along the way as well. You guys have been doing a great job with that. In addition to Twitter, we're also on Facebook. We'd encourage you to join our Facebook group at the web address you see in front of you. All right, with that, let's go ahead and tackle the market analysis for the day. As you can see, I've got the S&P 500 pulled up on the chart in front of us here. And as I mentioned in the intro, we did fall by about 0.2% today. That was about a 5-point move in total on the S&P 500. That leaves it trading at 2727. You'll notice that we continue to have a bullish posture, in fact, a strongly bullish posture, using that intermediate term line on the market forecast technical indicator. So as a reminder, anytime you see that background color, that dark green like you see right here, as opposed to this light green over here, what that's telling you is not only do we have a posture, or a bullish posture I should say, but it's a strongly bullish posture. Remember, we would consider it to be a strongly bullish posture if that green line down below here is above 50 and rising, or just simply above 80, which would be considered the upper reversal zone. So right now, with our position firmly in that upper reversal zone, in fact it's at 89.44 and rising, it wouldn't matter if it was rising or falling at this level, we would consider that strongly bullish. You'll notice that we are trading above a rising moving average. Remember, that moving average line will be colored green when we have that particular situation where price is above a rising moving average. We generally view that positively as well. There is one fly in the ointment that's worth mentioning. You'll notice that this candlestick pattern that developed here today, we'll have to see how it plays out, but some of you are looking at that and saying, well, doesn't that look like a hammer, or does that look like a hanging man? And the answer is both sides who would be asking that question are correct. Remember that in technical analysis theory, when we have a candle that's shaped like the one that we have here, where you have most of the body in the upper half of that particular candle, and then we have a long lower shadow, or a wick, however you want to describe that, it would be considered a hammer if it were at a support level. It would be considered a hanging man if it were at a resistance area. Of course, we do need to see what happens the next day to confirm that, but as most of you are likely aware, as we're sitting up here at this area, I think more people than not would probably say that was a resistance area. Now remember, technical analysis is always in the eye of the beholder. So if some of you decided that was actually a support area and you wanted to call that a hammer, you're welcome to do it. But just given the kind of the range that we've been in for the last couple of months here on the markets, I think more people than not would probably call this closer to resistance than to support. So be on the lookout for that potentially becoming a hanging man candle if we get another down day tomorrow. Let's go ahead and take a look now at our next chart setup, which will be our 4-grid, just to take a peek at what happened with the other indices here today. So I mentioned the S&P 500 was down 0.2%. The Dow Jones was down 0.3%. Down here in the NASDAQ composite in the lower left, we were basically flat. We were down 0.02%. So for all intents and purposes, we were flat. In addition to that, you'll notice that the NASDAQ has this red dot above the price action that corresponds with this red dot down below. Now, as a reminder, that just means that all three of those market forecast lines are in the upper reversal zone on the same day. And what that tells us is that we have some overbought conditions at the current prices. Whether that means we are due for a true reversal or not remains to be seen. But the way I generally think about them is that the chances of a reversal are higher now with that signal than they would have been without that signal. So keep your eye on that. We've had a nice run recently. There's no denying that. But remember, we can't just go straight up. We need to kind of inhale, exhale as market participants. And so right now we do have a bearish or overbought cluster signal on the NASDAQ itself. And the Russell 2000 actually closed higher on the day. So I think that's been our star performer over the last few weeks. Remember, we hit all-time highs on the Russell 2000 just Tuesday, the last time I did the video here. And we did pull back a touch yesterday, but we were up 0.04% today. So the Russell was the only one that actually finished truly in the green here today, although kind of like the NASDAQ, it was about as close to flat as you can get. As you look at the intermediate term lines on all four of our indices here, you'll notice all four of them are in the upper reversal zone. There's your Russell 2000, there's your Dow Jones, we already talked about the S&P 500, and then of course the NASDAQ composite. So all of them would still be considered to have strongly bullish intermediate term postures. But remember, you yourself may not be an intermediate term trader. So there's all different types of postures that you might be able to look at. But for those of you that are kind of practicing 2 to 3 months in advance as far as whatever type of trade you're putting on, then this can be a reasonable way to set your posture. Let's take a look at a longer term chart now. Let's go to chart 4D, and this is our 1040 crossover method chart. It's the same four indices here in the United States, but what's different about these charts is that we have a 3-year time period, so the other time period was 3 months, and then in addition to that, every one of these candles that you see on the chart represents one whole week in time as opposed to just 1 day in time. And so as we look at these, remember that it doesn't get finalized until tomorrow. Today is only Thursday, so tomorrow being Friday would be the close of the week, and then we can kind of wrap up that weekly candle and move on to the next. So anything could happen tomorrow, but since we're so close to the end of the week, it's worth at least examining what's been shaking out here recently. And what we're looking for here are crossovers of the moving averages themselves. As you can see, the 10-period moving average, in this case the 10-weekly moving average, it's an exponential, by the way, so there's different types of moving averages out there. So that E, when you see EMA right there, just stands for exponential. What that means is it's weighting more of the recent price activity a little bit more than just a pure average across the time period. But anyway, as we look at this, you'll notice that the orange lines are above the blue lines in all four of those charts. What that's saying is that from a long-term perspective, remember that's more than that intermediate term posture that I was just referring to. This is truly long-term in nature. We still have bullish postures on the major indices here in the United States. In fact, we've had bullish postures using this approach, which admittedly is a less sensitive approach. And by the way, that's actually a good thing for those of you that have been whipsawed a little bit too much in recent months. We've had bullish postures on all of these indices for 2 years at this point. So this isn't something that changes every week, but we have noted that in recent weeks we had gotten a little bit closer to that crossover potentially occurring with that orange line coming down closer to that blue line. Remember, you can use these MACD2 lines down here to kind of gauge that as well, because really this is just measuring the distance between the orange and the blue lines themselves. So if this black line down here would come down and touch that pink line like it did back here, 2016, that's when we would have that bearish crossover. So as you can see, just glancing at those MACD2 lines, none of them are really that close to that zero pink line at this current moment. And in fact, I would also point out what I mentioned before. If you look at the Russell 2000 down below here from a longer term picture, let's maximize that. You can see that again, we hit all-time highs here just this week, and we eclipsed some of those prior resistance areas over here. Generally speaking, it's a good sign when we see the small cap index leading the rest of the market higher. Let's go ahead and do some 12 grid analysis now. So let's do the intermarket analysis. So let's go ahead and just look for basic trends or potential reversals and kind of identify things that are taking place here today of note. One of the things to be aware of is that interest rates did fall today. So you'll notice up here the TNX, after having a violent rally to the upside, has pulled back fairly substantially here in the last few days. In fact, we kind of tie that up as a Rorschach test, or a kind of a mirror test of the chart rate below it, which is the TLT. And so remember that bonds and yields move inversely to one another. And a couple weeks ago, actually may have been just about a week ago, I mentioned when I was doing the market outlook video last week that we did get this bullish cluster signal, or oversold cluster signal, on TLT, and that we might have a reversion to the mean possibility coming up after that. And indeed, we've seen that follow through fairly nicely. So it's not a huge surprise that when we see bond prices rally like this, that bond yields are falling down like this. Where we stand on the TNX right now is actually kind of an interesting place. You'll notice that we have what I would consider to be a hammer in this particular case. Let me kind of show you that a little bit closer. I'm going to right click on that chart, go to maximize sell, and you'll notice that this candle looks somewhat similar to what we just saw on the S&P 500 that I was mentioning before, but look at the difference here. Here you could actually make the claim that this is a support area a little bit easier, because here you're sitting at what would be known as a diagonal support area. Remember that 30-day moving average is oftentimes used as a diagonal support area, and so we've had this pullback to that area. Sometimes we do find buyers stepping in at those levels. So with this shaped candle, what it's telling us is that earlier in the session, we were trading much lower on yields, but yields actually rallied halfway through the rest of the day and closed somewhat near the top end, or the top half of that candle. And so who knows, maybe this is the time where a little bit of stability will come back in for yields. And remember, that can have reverberations across the various sectors out there. Generally speaking, the financial stocks like your banks and your brokers do better if interest rates are rising, and your REITs and utilities generally do better if interest rates are falling. As we look at other charts here on our 12 grid, you'll notice that gold had a nice rally here today. So that was what I was kind of hinting at in the intro. That really perked up and took off after the news announcement of President Trump calling off that future meeting with the North Koreans. And I even tweeted about that. So for those of you that follow me on Twitter, remember, if there's ever anything that catches my eye on Twitter or in the markets, I will generally try to kind of identify that and post that on Twitter for you guys. So as a reminder, if you're not following me yet, my handle is @BrandonVanZ, all one word. First off, thank you to all of you that clicked the word like the last time I did the video on Tuesday. 157 of you spoke up and said you wanted these videos back every single day. And I know you supported David nicely yesterday as well, and we do thank you for that. But as you start scrolling a little bit lower here, you will see this particular tweet where I talk about gold securities perking up after President Trump calls off the meeting with Kim Jong-un. And those are four of the bigger known gold securities out there. Of course, GLD is well known by most of you in the upper left there as being the ETF that tracks the price of gold itself. These other instruments here, Newmont Mining, Barrick Gold, and Goldcorp, are three of the world's largest gold mining companies. And they all kind of ticked higher after that, and some of them even advanced further. So again, if you're interested in breaking intraday news, I would encourage you to follow me on Twitter as well. And while I'm over here on the internet, I should also mention what David always does a good job of, which is if you guys are on our website, you go over here to our blog up at the top of our website. This is the marketscholars.com website here. Remember, all of you that are paid subscribers to us will have access to watching classes like the one I did earlier today on dividend growth investing. So feel free to click on that blog and then enter into the class recording, or like my strategy lab class last night, you would have access to that as well. For those of you that are not premium subscribers to our website, but you're just our free subscribers, you do have access to our market outlook videos through our blog as well. So let me just use David's from last night as an example. So I'll click on that. And then I wanted to show you how easy we try to make it for you guys to click like on the various social media platforms out there. So you'll see a little bit of a write-up as far as, you know, what we recognize out of the market forecast indicator on any given day. The video itself that you can watch will be directly below that. And then if you scroll a little bit lower, you'll notice that right up here is our Twitter feed or a tweet that includes the market outlook video. And 143 of you clicked the word like there for David yesterday, and I know he does appreciate that. And then, of course, we also have Facebook listed down here where you can also click the word like, or in this case, I guess it's a thumbs up, and 41 of you did that for him. And you can also click like here on our website to let us know as market scholars that you appreciate these videos. And then lastly, you can sign up for our email distribution list right down below here as well if you haven't done so already. I know most of you have. So anyway, just a reminder that we try to make things nice and easy for you. If you just come here to our blog, you click those 3 things and you're on with your day. But anyway, back to gold. You can see gold has made a very nice move here. We were up over 1% on the gold futures contracts. This is a slightly different instrument than GLD. So gold per ounce right now is about $1,300. If I were to right click on that chart, go to maximize sell, you'll notice that we still have a market forecast bearish posture on this particular instrument, but as you can see down below, that green line is rising at a pretty rapid rate, and as soon as it emerges above 20, we would consider that to be having a bullish posture. So right now we're at about 15 and rising, so we're getting closer there. But the main point is take a look at some of these clusters that I identified a couple weeks ago when I was doing the market outlook video. And we really went sideways. I remember saying how for 2 days in a row, gold prices went nowhere, even though we continued to get those oversold signals right there. But the prices ended at almost exactly the same price 2 days in a row right there. So we didn't really do too much further downside damage. So it was good to see that we had these oversold cluster signals occurring, and then this particular security did not continue to go down at the same rate. In fact, it decided to go sideways up until today. Then, of course, we had that political news that sparked some interest out of the bulls, and we now see those bullish gold traders being a little bit happier here as we had a nice pop to the upside of over 1%. So we're going to review that a little bit more when we get to our trade application example. Before we do that, let's go ahead and take a peek at some other charts. Let's take a look at the foreign stock markets 12 grid. And here, as a reminder, when you see the different colored backgrounds on this particular chart setup, the green means it's a bullish posture, the pink means it's a bearish posture according to the intermediate term line on the market forecast. So right now, interestingly enough, we only have 3 bullish postures out there. We have Russia, we have Canada, and we have Israel. Now, Canada and Israel are not entirely surprising because we've been talking about those two quite a bit here in the Market Outlook videos recently. But Russia is somewhat surprising that is occurring. Now, remember, Russia is very oil-centric as far as their economy goes. And so who knows, maybe that's leading to a little bit of promise there. Oil did not do very well today, but it has been a little bit more robust recently. So that one, I don't know if I necessarily trust the trend, despite what the posture is telling us. The other two look a little bit more friendly, a little bit more inviting. We do have Canada's chart breaking out to the upside, and then as mentioned before, Israel shaping up fairly nicely with that pretty decent looking W pattern down there that's been playing out over the last 3 months. Otherwise, we still got a lot of ugly trends out there. Brazil continues to look ugly in our upper left-hand corner, and we have South Africa looking pretty ugly in our lower right-hand corner. Now, be careful on South Africa because, first of all, we have this oversold cluster signal, as you can see right here. But in addition to that, one of the major engines of the South African economy is mining, in particular gold mining. Some of you are familiar with Gold Fields and Harmony and a few others. AU is the ticker symbol. What was the name of that? I used to trade a lot of gold stocks years and years ago. Anglo Gold Ashanti, yes. So AU is another one. So there's a lot of South African gold mining companies out there as well. So the reason I'm bringing that up is if gold all of a sudden starts getting a nice little punch higher, you might see South Africa as EZA starting to benefit just a little bit for that. You know, keep in mind that this is going to also include media companies and all different types of companies as well. It's just that it's going to be a little bit more concentrated to the miners than most other countries that are out there. All right, and then let's take a quick look over here at our U.S. sectors while we're at it as well. You can see here it's a different story. Right now, money is flowing into the United States is what this is telling me. You know, we just looked at all those foreign stock markets and most of them were pink charts, and now we're looking at the various sectors within the United States and most of them are green. You can kind of get that sense that that's where money is flowing right now. It's not an opinion, it's just what's happening. Now, whether that continues or not into the future is anybody's guess, but right now we are seeing some reasonable charts out there. I mentioned energy stocks. They were the worst performer of the day, down 1.6% today. Remember, we did have those overbought cluster signals in the red dots right there, kind of warning us a little bit of that here recently. But oftentimes that type of a setup, when we're above that moving average, if we come right down here to this moving average and start finding a bottom right there, that could very well end up being a buyable bounce opportunity right there. When we look at interest rates, remember, they're going to be very, they're going to kind of motivate prices on utilities. And so utilities down below here with XLU, you'll notice have had a nice rally in the last 3 or 4 days. Again, that's largely because interest rates have been falling. But unlike the energy stock chart up here, which is also a bullish posture, this one I'm a little bit more cautious on just from a nearer term perspective, because we have kind of that V-shaped bottom right there where, you know, usually you just don't have a stock that goes straight down and then straight back up. So there needs to be kind of a resting period. And now that we're bumping our head up against that moving average right there, I'll be curious to see how utilities kind of handle this space or this moment here in time. We also have telecom kind of bumping its head up against that underside of that moving average down below here. Telecom was one of the sectors I discussed in my dividend growth investing class for those of you that were there. And again, that one's a little bit of a scary looking candle. If we were to kind of examine that a little bit closer, again, we'd kind of have that shape of maybe a hanging man type of a situation right there. So we do need that confirmation tomorrow to see that. But again, we've been spending more time under the moving average than above it here recently. So maybe just a little bit more caution towards that chart despite the intermediate term line rising here recently. You know, XLY has been a strong performer. Of course, yesterday, Tiffany just crushed it, was up like 24%. That was a stock that my class had been buying back in July of 2016, and that was for a dividend growth investing class back then, so it was a buy and hold type of a class. So many of my students were the owners of Tiffany, and yesterday was a very fun day for us because yesterday was our double day, meaning that we bought it for $60 per share. Tiffany did end up at about 125 or so here in the last 24 hours. So not only a nice 24% rally yesterday, but also getting the benefit of doubling our money in that particular class. So you can see money is drifting back towards some of those discretionary stocks. Another stock that did really well off of their earnings announcement was Lowe's, which is a dividend aristocrat company. And then today we had, I think it was Williams-Sonoma, that also has its own pretty decent dividend history, faring pretty well on a one-day basis. Now that particular stock had been struggling recently, and where we kind of ended today is in a little bit of a congestion zone there, but it was a nice upward move for Williams-Sonoma today, up about 5.6% there. So there are some areas of levity in this market. In particular, the discretionary and the energy companies have been kind of our leaders of late. All right, so then that leads us to, actually, you know what? Let's take a look at the VIX. I know sometimes if I don't look at the VIX, I hear about it. So let me do this. Let me come back over here and just briefly pull up the VIX for those of you that want to see that. Just ticker symbol VIX on the TOS charts, and the VIX was flat yet again today. We haven't been talking a lot about the VIX recently because there just hasn't been anything to discuss about the VIX recently. Maybe today it's actually a situation that's worth talking about, the fact that nothing happened to it, because normally you would expect that on a day like today, where you know the kind of the nuclear proliferation within North Korea is at the forefront of everybody's mind, and then all of a sudden we call off these talks with the North Koreans coming up here in a couple of weeks, that you know this would have been a day where everybody would have been in a tizzy, and we would have seen a lot of fear entering into the marketplace, and that's usually reflected in the VIX. So maybe if there was any story here, it wasn't the price movement itself of the VIX, it was the lack of price movement in the VIX, because the VIX actually closed lower on the day by 5 cents, basically a nothing move for the VIX. So we'll keep our eye on that. Now remember, they do have a oversold cluster right now, but you don't really view clusters quite in the same light light with the VIX as you do with other securities, because you don't really have the VIX as a trending type of a security. Usually the VIX is more of a sideways, drifting lower type of a situation, and then when it goes up, it just bursts higher by 20% in a day or something along those lines. So we don't really view the technical analysis on the VIX itself quite the same as we do on most common stocks. All right, let's now get into our trade application example for the day. So for this, I wanted to pull up Royal Gold. Now, this is not one of the most popular gold companies out there, but it is one of the most expensive. I'll note that. It's about a $90 stock here. Most gold stocks have been just blitzed over the years, and many of them find themselves in territory below $10 per share. So investors have allowed Royal Gold to really retain much of their value over the last couple of the years that they haven't allowed some of the other gold mining companies to do. Now, for some of you that aren't aware of the gold mining industry quite as well, be aware that Royal Gold, the reason they call it that is it's actually a gold royalty company. Now they have kind of changed their colors a little bit as time has gone on. It used to be purely a royalty company. Now they do own some actual mines themselves. But anyway, the driver of their business is still their royalty streams. And what that means is in many cases, these high oil prices and high employment prices are not going to affect them as much as a traditional gold mining company that has to go out and pay for gasoline and diesel fuel and also has to pay its workers. Basically, Royal Gold is almost a financing arm in many cases where they supply money to gold mining companies, and those gold mining companies in return give them a sliver of the future profits of any gold streams that might come out of those mines. So it's kind of an interesting business model in a certain type of market environment. And when we have high employment costs and high oil prices like we do right now, this is the type of environment where they can probably excel a little bit more. So you'll see that today they had a very wide-ranging day. You'll notice that our ATR label up at the top of chart 4A, for those of you that are following along at home with our premium charts, we have that colored in orange. Remember, if it's colored in blue, it means that the daily range was less than the average true range, the ATR. If it's colored in orange, it means that it was more. So today was an outsized day. We had a $1.72 of range from high to low on today's candle for Royal Gold. Typically, we're only seeing $1.52. So the bulls were in this in earnest today. In fact, they were in it in earnest to the point where they were able to flip the posture around. You'll notice that yesterday we had a bearish posture on this, but with such an aggressive move to the upside today, we flipped it back over here to a strongly bullish posture as that green line down below here reversed course and started to head higher. You'll notice that we've largely been trading in a range here for the last, let's call it month and a half or so, but it is up over the last 3 months. So it's maybe doing a little bit better there, especially in comparison to a lot of its gold mining compadres out there that have struggled a little bit more. So for this, I thought what we'd try to do is take advantage of reasonably low volatility right now. As we just saw a moment ago, the VIX is quite low. And remember, when we're the buyers of strikes, or the buyers of premiums, however you want to describe that, we can take advantage of that lower volatility or lower relative volatility. And so I thought we would do here today is take a look at buying a call spread. Now, I will note that this is not the most liquid name on planet Earth, so be aware of that. You will notice that these particular contracts that I'm focusing on here, and these are the July monthlies with 57 days till expiration, these ones are not bad. Some of them are in the hundreds. Here's one in the thousands. So it could be worse. Remember, there's a lot of other gold mining companies out there that attract zero interest whatsoever. And so at least we've got some decent open interest here. But admittedly, this is not the same type of open interest that you're going to see if you're trading something like GLD itself or most of the other mega cap stocks that we normally focus on here. So I'll just sound that word of warning out there for those of you that like a lot more liquidity. But when we're buying a call spread, typically what we're trying to do is we're trying to straddle an at-the-money strike with buying an in-the-money strike and selling an out-of-the-money strike. So right now with this stock basically at $90 per share at today's close, we want to buy the first one that's in the money. In this case, it'd be the 87.50 call. We have a fairly tight spread there of only 20 cents between the bid and the ask, so that's good to see. And then down below here, we would also be selling the 92.50 call as part of that spread, maybe a little bit more of a spread difference there, but not bad, all things considered. Again, most people have never even heard of Royal Gold before, so honestly, I figured the spreads would be looking worse than they actually are right now. So in order to do this trade, what I'm going to do is I'm going to come up here to the 87.50. I'm going to right click on either the bid or the ask. It doesn't really matter. I'm going to come over here to buy, and in this case, I'm going to go to deep and wide. Let's do 2 month. 2 strike, actually 1 month 2 strike vertical, sorry about that. There we go, and just to verify, we do have the July contracts pulled up down below. And what that did for me to go to the deep and wides is it basically allowed me to load up this trade down below without having to manually adjust my strikes, because if you just go to buy vertical, then you'd have to flip that other strike to whatever one you're trading. So anyway, you can see here that our debit is about $2.50, right around there. Now remember, these prices are as of the market close today. Who knows what happens tomorrow? I've been missing a lot of trades here recently because the markets have moved against me before I was able to get filled in recent weeks. So, you know, if gold bounces first thing tomorrow morning, the chances of us getting filled on this trade is probably a lot less, just to be straightforward with you guys on that. And that's the downside of doing these videos after the market closes. But anyway, that is what I would anticipate. Right? If we have a stock price very close to the at the money strike, then the debit that we're paying out of our pocket should in most cases be 50% distance between the width of those strikes in our spread. So since we have a $5 distance right here, 50% of that would be about $2.50. Okay, so that's about normal. Maybe paying a couple of extra pennies than we normally would, but in the end, it's not the end of the world. And so we'll go ahead and place this trade. And by the way, just to make sure we're all catching up to speed here, what we're hoping to accomplish here with this is we want this stock to continue to go up. Now, if it continues to go up, we'll have the ability to make about $250 on just doing one contract here, because we're paying $250 out of our pocket in order to access a $5 spread. If this $90 stock goes up to $92.50 in the next 57 days, then we'd have that opportunity to make close to that $2.50 per contract, or $250 total. So in other words, it's a way for us to take a bullish trade, and rather than just buying a call outright where we know that time decay is going to work against our trade, we can also sell a strike against that. In this case, we're selling the 92.50 to make some of that time decay back. Now, if you thought this stock was going to launch to 115 bucks, you'd never want to do that, because essentially what you're doing by selling that 92.50 is you're selling away your upside potential. But as long as you think this will continue to go up at a fairly healthy rate, but just not spectacularly, then this can be a way to take advantage of that. So with that, let's go ahead and click confirm and send, review that one last time, and ship that off to the market. And we'll see if we get filled on that tomorrow morning. All right, well, I want to thank you for joining me here tonight. I always appreciate your guys' enthusiasm around these videos. David and I enjoy doing them, as well as teaching all the rest of you in our live daily platform as well. So with that, I want to wish you all the best. Let's keep our eye on this North Korea situation here, see how stocks respond, and also in this case, see how gold responds. With that, have a great rest of the night. And by the way, have a great Memorial Day weekend as well. I'll see you guys next Tuesday. David should be back on with you tomorrow. Take care, everybody. Bye-bye.